Well, welcome everybody, and thanks for joining us today. I'm absolutely delighted to be given the chance to moderate a conversation between two of my favorite people in the world. Well, one favorite person, one favorite chicken, I suppose. Felix Zulauf, who has, in tribute to the backwards world we're all living in, got his camera turning backwards. Felix, welcome.
Thank you, Grant. It's a pleasure to be here. Thank you. I thought the world is upside down, so we, as right. A joke, to the tribute to the world upside down.
I think that makes perfect sense. And also joining us from a coop somewhere, who knows where, the green chicken himself, Doomberg. Hi, mate. How are you?
Grant, Felix, really fantastic to be here. I'm doing great, and pleasure to join this webinar, combining all three of our outstanding subscribers.
Well, look, there is so much going on, and Felix, I'm going to kick off with you. And if I may, every time you and I talk, I just love to sit back and get your take on the world and the kind of roadmap you've been laying out for me and other people over the last couple of years has been eerily accurate, and you've been laying it out several years in advance with fluctuations in both directions. So I think the perfect place to start would be to really get an update on that roadmap of yours, where we are in how you saw this inflation deflation argument going, the bull bear cycles, and really get a sense of where you think we are. So if I can kick it over to you to begin with, perhaps you can walk us through the world as you see it right now.
Oh, it's how much time do I have?
Hey, it's your webinar.
It's a complex world, but I try to simplify to make it easy to understand. I think we have entered the period of geopolitical change, world disorder, the world trying a new order, and that's a transition period. So we have a geopolitical crisis, including war, and I think this is only the beginning of a war that will eventually spread and divide the world in two pieces. Then we have, not the least because of the war, but primarily because of the climate apocalyptic crowd, we have an energy crisis because we underinvested in fossil fuels. We try to move away from nuclear, particularly in Europe, etc., and that has created, in combination with the war, an energy crisis that will not go away very quickly, but will last for several years, I believe. Then we are entering a fiscal crisis, in my view, and we are in the very early stage of that. Great Britain showed that a little bit in the past 20 years, and particularly the last 10 years, we had governments solving or covering all the problems by going into deficits and providing support by increasing expenditures. And the central banks financed it by creating more money. And I think with the inflation, the bond market has woken up to the problem and will become vigilante. It isn't yet, but it will become more vigilante over the next few years. And so there is going to be a fiscal crisis. And I think there is also a social crisis within many countries, divided society, one subscribing to the woke agenda and the other one rejecting the woke agenda and things like that. And all of these things are coming together and creating a hell of a messy world. And now, due to the fighting of inflation, or the first wave of inflation, we have a shortage of liquidity in the global financial system. We have therefore declining asset prices, and we will soon see weak economies around the world. I mean, many regions are already quite weak. I think we will have a combined recession in the first half of next year, and we will come to a pivot point at some point. I do not know what the event will be that will trigger a change, but I expect sometimes in the first half of next year, I'm expecting a pivot point where central banks get the signal from the markets and from the economy and from some events out there that they have overdone it, and then they will change. and then they will try to run it up again, and the markets will celebrate it, and we have another hurrah. But unfortunately, whenever you create more liquidity, it flows to where there are scarcities, and that's the commodity segment. And as commodities go higher into 24 and maybe even 25, we will see bond yields breaking into much higher ground and creating a new form of depression, starting from somewhere 25 on, and a pretty messy situation with all the crises that are going on and I described before. So that's the general picture. And I think we are in the later stages of the equity market decline. We have a temporary recovery attempt due to technical oversold conditions, and the hope that the Fed will slow down its hiking of rates, and the hope that the Republicans will have a landslide victory on November 8th, and that will drive the rally into later this year. But I think it's a bear market rally, and it will be followed by a pretty brutal sell-off in the first quarter.
Well, Felix, I want to get into the energy component of this for a second, and I'm going to kick that over to Doomberg just to start off. But just one thing I want to just clarify there with your roadmap, and that's this idea of pivot. Obviously, it's a Fed day today. Everyone's watching, desperately hoping that we'll see, if we do see 75, it will be with some words suggesting that the next one will be lower. And this idea of pivot has kind of got everybody captivated. And you wrote in a recent update, you talked about the events in the UK, and I've got a quote from you here where you said, the BOE went from QT to QE in one day. This type of pivot is likely what lies ahead someday this coming autumn, winter in the US as well. Can you talk a little bit about what you saw and why, given the catastrophic state of the UK's finances, why that extra 2 billion, which seems meaningless in the broader sense, seemed to topple the sand pile?
Well, first of all, Liz Truss was not the selection of the World Forum crowd for the right. World Economic Forum crowd. She was the wrong person, and they had to replace her. Secondly, the UK is running a current account deficit on the order of over 8% of GDP. That is monumental. And when you have such a situation with already large budget deficits, and then you go into a situation where you apply tax cuts all financed by new debt, then you create the havoc. It's like when you're driving, I don't know, sometimes it's important that you push the pedal down when you try to pass someone, and it's a risky situation. But when you come to a stop sign, you cannot push the pedal down. So it was the wrong timing to do it. It's the right strategy, but the wrong setup and the wrong timing. And I think the US will next year or so will see the same problem. You know, the deficits will grow bigger with the recession that I see, and the demand for money, for treasuries, is outstanding. You see that the Treasury is selling treasuries at large quantities. You see the Fed is selling treasuries. You see the foreign central banks are selling treasuries to finance their growing current account deficits. Everybody at the banking sector is selling treasuries, so everybody is selling treasuries. So at some point of time, you will have a quantum jump higher in the treasury market. I cannot tell you in advance when it will be, but I guarantee you in the next 2 years, and probably sooner, we will see it.
Well, we're going to come back to all this stuff later on, but you mentioned energy there, and it was a perfect opportunity to bring you in, Doomberg, because you've been writing some phenomenal stuff about the energy market. So I'm going to try and get an overall sense from you of the kind of balance of energy markets, if I can. But before we do that, for anybody out there that's wondering why they're watching a cartoon green chicken on the screen, perhaps you could let people know the story behind why you are as you are.
Hi, Grant. Yeah, and first of all, before I dive into that, I want to say I agree wholeheartedly with everything Felix just said, and we have our own interpretations as well that might add some color. But by and large, the energy crisis is driving. It's the stick that's stirring the global soup of chaos that we're seeing today, for sure. To your question about the green chicken and Doomberg, as you know, we've built this Doomberg brand in less than 2 years from a starting stop, and our success can be attributed to our ability to harness and master the modern way in which news is being consumed today, and predominantly that means on Twitter. And we decided early on that in order to grow a brand, it's much easier to grow a brand if you stand out, and the green chicken certainly is memorable. And one of the things we've learned by studying the market is that if you begin an anonymous brand and you have some success with it, the worst thing you can do is personalize it by becoming an individual and stepping out from under the brand, and that sort of collapses the brand intrigue. And as fast as Doomberg has grown and as successful as we've been with developing our writing and creating a business around it, we've decided that we will stay anonymous and we'll stay on brand. And the green chicken, as you see, is here speaking in front of you. And it's a fun inside joke. Many people know who we are, of course, in real life, including you. And so that's the background story there on the green chicken.
All right, perfect. Well, let's get into the energy markets then. You've talked about energy being the stick that's stirring up the soup of chaos, which is a fantastic analogy. So just give us an overall assessment of the energy, where the stresses are, and what you think some of the policy mistakes that are being made, because you've written extensively about those.
Yes, happy to. And Felix correctly alluded to the core issue, which is a radical underinvestment in the development of primary energy. Currencies are basically just overlays of energy. Energy is the master currency, and financial currencies exist to efficiently deploy our energy to develop the maximum amount of standard of living integrated across society. Literally, your standard of living is defined by how much energy you get to waste in the never-ending battle against the forces of entropy. For a period of several decades, we were in a period of excess primary energy, predominantly because of the technical revolution in the shale patch, coinciding with access to cheap money. Zero interest rate policies on the central bank allowed the producers of such primary energy to burn through enormous amounts of capital with minimal consequence. All that changed with the response to the COVID-19 pandemic and the associated lockdowns, and the world pivoted from a period of primary energy abundance to a period of primary energy shortage. And all of the things we're seeing today, when you have a hammer as a weapon, everything seems like a nail, but we can explain most of what we see in the macro world today through the lens of the pivot from excess primary energy to a shortage of primary energy. And when you have a shortage of primary energy, two things really matter: your direct access to it, and whether or not you can acquire it by printing your own currency. And the only country in the world that can do that today is the United States, because by and large, the vast majority of energy transactions are settled in US dollars. And countries like the UK or regions like the EU or countries like Japan cannot do so. And this is why we're seeing a substantial weakening of their currencies. And the analogy, of course, is this is equivalent to an exogenic shock of a developing nation. They have basically hard debts in US dollars to pay for that they can't print in their own local currencies. And so the United Kingdom pension crisis, or the depreciation of the euro, or the battle for the yen, as you've written about so eloquently, all of these things are really just manifestations of the energy crisis, because all three of those regions do not produce enough of their own primary energy, nor can they settle their energy needs, their deficits in local currency. And until either or both of those things change, we're going to be creating from crisis to crisis that central bankers cannot financialize.
So Felix, you're nodding along with that, as am I. This idea of challenge to the US dollar hegemony as the global reserve currency has been something that's been talked about for a decade now. There have been various dots that one can join to see how that trail has been progressing. But it's always been kind of a matter of preference for countries that would prefer to not have to deal in dollars if they could avoid it. Now we seem to be reaching a point where it's almost imperative that people find a way to get around the dollar for exactly the reasons that Doomberg's described. Do you see that that challenge to the dollar hegemony becoming more and more real? And if so, How do you see the roadmap for that particular challenge playing out?
Well, to my knowledge, there is a agreement between the Saudis and China that the Chinese can start buying oil settled and paid for in yuan, in renminbi, and not in US dollars again. It hasn't happened yet, but I think it will happen in a short period of time. And this is a break of the old contract between the Saudis and the US from the 1940s. We protect the Saudi government and the monarchy, and you sell oil only for US dollars. And if this changes to the yen, which is to the renminbi, the yuan, which is the second largest economy, and I would say the counterpart to the US, then of course it changes a lot, because it will mean that over time others may also be paying in yuan, and it means that it weakens the status of the US dollar as the reserve currency. And as it weakens the status of the US dollar as a reserve currency, it really gradually weakens the status of the US economy, because at some point of time, China may even come up with some others together with an alternative currency. That is in discussion, and I think sometimes in the next few years they will come up with a non-fiat currency to settle trade, which is backed by the commodities those countries produce and linked to the gold and something like that. So a non-fiat currency. If all those things happen, and they will happen because of the growing conflict between China and the US, and the US overdoing so many things on the political, geopolitical, as well as on the economic side, it weakens the US dollar. So I think that probably next year or in 24, or whenever this next final hurrah is over, which my guess is in 24, it could be in 23 for the dollar, then the dollar will have peaked for a long time, and it will begin a very multi-year long decline to much lower levels. And that will make the life of the US much more difficult, because all of a sudden the price of oil can go up dramatically in US dollars, and it cannot go, and it may not go up in yuan, things like that. We do not know that exactly, but I think it's going to weaken the US position in the geopolitical context. And I think the US has really messed up geopolitically. It has created China, it has declared China as an enemy. The Biden administration did so. Trump was blunt in words, but he was diplomatic on trade. He just wanted to have fair trade. But this administration really blew it, and they have provoked Russia to start a war, which will eventually create another bloc between Russia, China, Iran, and now you see even the Saudis are tipping over to that side. In the old times, when the US president asked for an increase of production of oil to ease tensions in the world economy, the Saudis would have cooperated. This time they even cut by 2 million OPEC. That tells you that the world is beginning to change. And I think at the end of the day, the US government has really to think hard about it, how they mess it up, because if they do mess it up, they will become isolated. Just, there is a trip by the Chancellor Scholz in Germany. I mean, the German economic model is bust. They have tried, they have put themselves strategically in the most horrible position you can get in. And now they have their biggest trading partners are the US and China. So at some point in a conflict situation, as I see it developing, they have to decide which way they want to go. And they are now traveling to see China and talk to the Chinese and see how they could continue trade under tense geopolitical conditions. On the other side, you see the US trying to woo German multinationals to invest in the US economy instead of Europe. And because Europe has become too expensive. I mean, when you measure the cost of energy as a percentage of GDP, usually on average for the world economy, it's about 7%, and it swings around the 7%. It recently went to 12, 14%, which it was in the early 2008, just before a crisis. And in the US, it is near 7%. In Germany and in the Eurozone, it is at 18%. So it means that it's impossible to stay competitive as an industrialized place with such a starting position. It's impossible. And therefore, I think the US should think very hard about provoking more problems in the world, and at the end, ending up isolated because others go together. You know, when you look at the map, you see the Eurasian continental bloc, which goes from the Atlantic to China, and the interlink is Russia. So you could have European technology, Russian commodities, and Chinese manpower. And that is what the US has been afraid of. And that's why they really cut the link between Russia and Germany on the energy side. They even sabotaged the pipeline that is now clear. I mean, they designed it and the British executed it, according to the latest news. So it is an obvious power play in geopolitics. And in the center of it all is energy, as Doomberg rightly says. It's energy.
Well, let's excuse me. Let's stick with that, Doomberg. Let me come to you. Felix was talking about Germany there, obviously, which is right in the middle of all this, and I'm going to weave in one of the pre-submitted questions here. Doomberg, just you've written an awful lot about Germany's energy policy, so perhaps you could kind of lay that out for us, but weave in the answer to a question about Germany's ability to selectively turn gas on from their reserves from different parts of Germany and other countries, and also the same person is asking whether there's any logic with the US doing a deal for oil with Iran.
Sure. So to take them in order, Germany, as Felix correctly articulated, has put itself in a worst possible situation, and it has essentially set itself up for massive deindustrialization. And so just to get through this winter, you know, and we joked this morning on Twitter that, quote, survive the winter equals successfully deindustrialize. You know, there's a lot of talk about storage, and we've written about this extensively. Congratulations to the Europeans for storing as much as they could and paying the market clearing price, exorbitant market clearing prices for the incremental LNG carrier of natural gas. And fortunately for Europe so far, knock on wood, it has been a very mild late fall season, which means that the prices of natural gas have come off of their unbelievable record highs. The problem with storage as your primary defense against a complete loss of supply from Russia is twofold. Most countries in Europe only store a fraction of their annual capacity. So to be 95% storage capacity filled means nothing when you only can supply 5% or 10% of your annual natural gas needs from storage. Germany in particular is a little better, somewhere around 23 or 24%. And then you have countries like Austria who can store up to 75% of their annual needs. And so they're in much better shape, assuming they haven't already pre-contracted the sales of those storage to other countries, at which point in a true crisis you would see protectionism kick in, we believe, and Australia would act in the interests of its citizens before honoring its contracts, the ultimate force majeure. So with respect to Germany, the second problem, of course, is the daily rate at which you can extract from storage or natural gas is gated by mechanics of these underground storage facilities. And so to short your grid, of course, all it requires is that you have less than demand. and then you have rationing and rolling blackouts. And so if the weather holds and Germany does well, and Europe by extension does okay, industry contracts by 10% or 15% of its demand, they will, quote, survive the winter, but the economic taters that they will find themselves in will be pretty substantial. And then, of course, they get to do it all over again for the winter of 2023, except this time with no access to Nord Stream because the pipelines have been destroyed. And much of the natural gas, the molecules sitting in storage in Europe today, flowed through the pipelines that ran under the sea that were destroyed. And you know, the collapse of Liz Truss and her prime ministership so quickly might have something to do with some unfortunate text messages that have found their way into the domain. And so this winter might be okay if you're willing to sacrifice your industry, but then what happens again next winter? To the point about Iranian oil, we think this is a bit of it's not a very big deal. Most of Iranian oil is finding its way to the market via the black market. And if it's just brought into the proper, you know, if a deal is struck with the US and it legitimizes Iranian oil, maybe we'll see a minor price drop because of the black market. The premium will be removed from the market, but by and large, Iranian oil is largely finding its way to the market. And the people who are buying it today illicitly represent less demand in the sort of US dollar approved markets. And so all of this would probably even itself out. I don't think Iran is all that big a deal in the equation today. That's our view.
Felix, there's a follow-up question to this asking whether the problems being faced by Germany right now in the energy space and the hit it will have to their competitiveness, as to whether that will change either their role in broader Europe or their attitude towards Southern Europe, which is the perfect kind of pivot point for us to come on to the EU, because it is under enormous strain again. We've seen this movie play out many times before, and people have called for the end of the euro and the end of the EU many times. You know, I recently spoke to Sir Stephen Wilkinson, and he was explaining why the Germans will absolutely do anything to keep Europe together, and they will allow inflation to run hot if needs be. They're not going to sacrifice everything on the altar of higher inflation. I'm curious as to your thoughts on Germany's changing attitude towards and role in Europe, and your broader views for Europe and the euro as a currency in the next sort of 5 years.
Well, Germany is clearly or has been the strongest economy in Europe, and for many years the locomotive. I think the German economy will probably suffer the most weakness in the years going forward due to the deindustrialization Doomberg mentioned, and I completely agree with. And therefore, Germany is becoming a weak member of the EU. It's still biggest in size, but it's the weakest of all the members relatively speaking, which of course the French like. That was always the goal. And I think, you know, the euro and the European Union is really a union because of weakness. It's not a union because of strength. They have all joined because they are weak. And I think it's a political union. Germany should never have allowed it to deteriorate in the direction it eventually went. But the Germans, having started 2 world wars, they are all brainwashed, and they are not patriots. They are Europeans. When you ride through Germany, you hardly see any German flag. You see flags from the individual states or cities, but you don't see the German flag. That is a leftover from the war times. And therefore, I think Germany is prepared to suffer a lot to keep the European Union together. Now, if the German public finds out that their good friends, the Americans and the British, blew up their lifeline in energy, maybe that is going to change a few things. Maybe then they have second thoughts about who really is their friend. And I think Macron, the French guy, he realizes all that. He has been the least supportive of the war in Ukraine. He doesn't like the way the Americans act. France never liked the way American acted, but I think Macron is the only guy among the European leaders who understands what game is being played. And I think recently there should have been a meeting between Macron and Scholz, Chancellor Scholz, which was cancelled because of too much disagreement, obviously. So I think the two have to find a way how to move forward with the European Union. And I think the European Union will eventually be weakened dramatically. It is the region that will be hurt the most by these geopolitical trends and energy trends that we are discussing. And usually in a weakening environment, the stress test will come. I think the stress test will be passed this time on the recession 23, but I think the bigger stress test will be coming in the next big decline, that is after 24, 25, 26, 27, where I see a multi-year recession or depression going on, and that I think will be the big test for the European Union and also for the euro.
Well, let me switch, because I want to make sure we get as many of the topics that we want to talk about in as possible in the hour. Let me switch the topic to Japan, because again, Japan is a country that in the 80s, 90s was incredibly important and has kind of diminished in its importance as it's become something of a kind of isolated sideshow for many. And we've all been watching with fascination this Bank of Japan battle with first the bond market and interest rates, and it's become almost comical to watch. But recently we've started to see the awakening of the vigilantes in Japan, which was always going to be a canary in the coal mine, I think. And Dumi, you've written about this before. So talk a little bit as we watch the Bank of Japan's peg on the 10-year JGB start to get challenged. We look at yen swaps suggesting that it's going to break, and we look at what's happening to the yen. You've written about this recently. Talk a little bit about the predicament that Kuroda-san and the Bank of Japan find themselves in, and what you think is liable to happen from here.
Well, as you've written about, and we have as well, and others have known about for decades now, it seems, this is the ultimate Widowmaker trade, of course, because it just seems impossible that they could, as Luke Groman would say, ride two horses with one ass. How do you keep the currency stable while also keeping a lid on yields? And yes, the 10-year is capped, but the rest of the yield curve would tell you that the battle is already lost. And the depreciation of the yen this year has been really monumental, truly extraordinary. This is one of the 3 or 4 most systemically important currencies on the planet, and it is depreciating at a historic rate. And we shall see. The amount of money, quote, U.S. Treasuries, that the Japanese are liquidating in order to support their currency in what seems like a losing battle is truly astronomical, tens of billions of dollars a week. And the old expression is that which can't go on forever usually doesn't. And ultimately, I think we could see the yen at 170, 180 on the way to much higher numbers if things spiral out of control. And another great expression that we have, these expressions are wonderful because they're almost like the spoken version of memes. They capture so much information. But another expression that we have is it's amazing how fast you run out of money when people think you might. Ultimately, liquidity in all its forms is nothing more than a confidence game. And if the market begins to lose confidence, which is just another way of saying the bond vigilantes take control of the steering wheel, this could happen very, very quickly. As famously long-term capital management found out when the correlations no longer work and everything goes to one. And so we shall see. I think we wrote the piece, The Battle for the Yen, a couple of weeks ago because everyone was looking at Europe. But in fact, as you know, and you've written about, and Felix has spoken about, all it takes is the first domino to fall. And if the yen were to, quote, fall, and we would see a massive spike in yields and ultimately a bankrupting of the fiscal situation in Japan. They're one of the largest foreign holders of U.S. Treasuries, and if they're liquidating Treasuries into an illiquid market, that would of course be the root cause of a Fed pivot, perhaps the magical Fed pivot, And so then stocks might rally in nominal terms, but then you would really be looking at a truly inflationary, potentially hyperinflationary environment in the global economy, especially in those countries that are deeply short energy.
Felix, let me bring you in on this, because I'm fascinated to hear your thoughts on this. You know, you've traded currencies for many years. You've seen interventions before. It feels like something's different this time in the speed with which these interventions by the BOJ, significant interventions, have been reversed. How important is the yen right now to the rest of the global macro picture?
Well, from an economic point, Japan is not that important any longer in an isolated way. But the yen is important because it feeds back into the U.S. Treasury market, and if a currency like the yen, which is I think the third or fourth largest reserve currency, declines at the speed we have been seeing, then it forces the central bank to intervene at some point, because they always like to see inflation coming up, but not to the degree that it is coming up and showing up right now. And so they are forced, as Doomberg says, they are forced to sell treasuries, to sell US dollars and buy yen to support their currency. Then of course it has international ramifications, because then it could be the trigger that breaks the neck of the U.S. Treasury market when you take all the things that we mentioned before together. And the U.S. Treasury market is the pace setter for international bond markets. And I think what's different this time is in the old days, we had central banks that were there to smooth market moves, and they were always relatively calm. I think that today's generation of central bankers, they have been manipulators and movers and shakers, and what it also shows is all of a sudden they lose their nerves and throw in the towel and panic. So it's a different behavior by central banks. It's almost like a big speculator reversing its position and things like that when they show up. So I think this is different, and I think what's also different is that the room for maneuvering is getting smaller and smaller. You know, it was very easy during the time of declining inflation and declining and low interest rates to intervene and manipulate the way governments and central banks liked. This game is over. We are in a new era. They are now driven by the events, and the events are moving in the wrong direction. They always have to react. They cannot look forward far enough. They are sort of in the day-to-day business instead of a strategic business, and that has changed. That is a big change, and it makes itself felt in the markets that you can have very sharp moves, dramatic moves, as we have seen in the currencies recently and in the gilt market, and we will see, in my view, in equities in the first quarter and in treasuries and things like that.
Well, I'm going to come back to some slightly more specific questions. I'm trying to fold as many of the questions we've been submitted into the conversation as possible. Now, there's been a few that touch on capital controls, and seeing as we're talking about what we're talking about now, it seems as though the inevitable pathway that this will ultimately take is towards capital controls. How likely do you think that is, Felix, particularly in Europe, particularly in the US, and what would it take for capital controls to be implemented, do you think?
Well, it will first come in the countries that are large importers of energy and are running current account deficits. I'm not sure whether you have noticed, but the trade surpluses of Germany and the Eurozone is gone, and we are falling into deficits, and because of the terms of trade and the slowing of the world economy and the divided world economy that will intensify over coming years due to the conflict between East and West. And I think once a currency territory begins to lose capital that is flowing out because of fear or whatever the reasons, the driving reasons are, at some point, the central banks, when they see they are losing control, they implement currency controls to stop the bleeding of capital from their own system. And I would expect that to come first in Europe, maybe in Japan also, and the US last, because for a while the US will be considered the safe haven, because the US is almost self-sufficient in energy and is considered a safe harbor in a geopolitical situation that is becoming more dangerous, and therefore the capital flows to what the perceived safe haven is. So I think the US will come last with that. That is a few years down the road, but it could happen first in Europe and in Japan.
Thanks, Felix. Doomberg, so if this happens, if this capital controls, financial repression, whatever term you want to use for it, if that does happen the way Felix suggests, the smart money always moves in advance of that, and there's enough smart money to suggest that if Felix is right, and I think he is, that the US dollar and the US will be a safe haven for that. That suggests that there is even more pain to be felt from the rising dollar in the short term if we get that kind of feeling spread about potential capital controls.
Yeah, and I would only add to what Felix correctly said, which is, in fact, if you draw a box around the US, Mexico, and Canada, the NAFTA region is more than energy self-sufficient.
Mm-hmm.
And the sort of balance of trade for the US energy needs is largely supplied by Canada. And then if you just combine the US and Canada, the region is an energy powerhouse. And then if you can mix in Mexico with all of the sort of the assets that they have and the workforce that they have and their desire to continue to climb up the development ladder, you have a really amazing combination. And so that only further strengthens at least the temporary cleanest shirt in the closet analogy for the United States. And as long as it is still the reserve currency for most of the world, they will ride that advantage as well. And I do think, again, if you analyze the world through energy, you can very clearly come to the answer. And look, I mean, all of this, of course, are just symptoms of the greater disease, which is the reverse of the 40-year bond bull market. And the bond bull market was driven by two things: the deflationary effects of globalization and the relative primary excess energy that the world was fortunate enough to be able to develop and deploy. Both things are going in reverse. As you go from unipolar to multipolar, the unwinding of the deflationary effects of globalization are pronounced. And then also because of underinvestment in fossil fuels and the lockdowns associated with COVID, we are now pivoting away from primary energy to energy deficits. And so if you have a reversal of the deflationary effects combined with a period of primary energy shortage, then you have to take all of the trends that we've become used to. And all this is, as I was listening to Felix talk about the models that the central bankers are using, they're still playing by the old playbook. But in fact, the absolute opposite is actually what's transpiring in the markets today. So all of the trends that we've grown accustomed to in the last 40 years, a far superior model would be to negate those and then to try to understand the consequences of that negation. And I think the reason why we're seeing central bankers being caught offsides and on their back foot is because they have internalized neither of those two sea changes in the fundamental assumptions of their working models.
This all brings us around to the kind of overarching theme of everything that we watched today, which is inflation, because that's the kind of spanner in the works that is preventing the same solutions being applied to cure what ails the world again. So we've got 15 minutes left. Let's talk about inflation. Felix, you've written a lot about the way you think this is going to go. So perhaps we could kick off, if you could lay out your roadmap for inflation with the pivot in mind, what you think will make them pivot and what happens to inflation once they do. And also, one of the questions was what this might mean for investments, things to go long off post pivot. And I know you've written beautifully about the importance of staying in cash, which I happen to agree with you wholeheartedly. So perhaps you could feed that into your answer if you wouldn't mind.
Well, inflation is here to stay, but inflation is not linear. It goes in waves, in cycles. And I think the first wave up is almost over, if it isn't already the rate on a rate of change basis, the cost of living. And then we are measuring inflation in the wrong way. The way we measure it is really primarily traded goods and not services. Services are underweighted in the inflation statistics. And you really had over the last 20 years or 30 years, a big gap, growing gap between service inflation that continued to go up and goods inflation that was very, very slow, kept down by globalization and the Chinese entering the world economy. I think at some point of time, these two are going to narrow, the gap is going to narrow. Maybe they could even move close, very close together. I think that inflation is going lower into, let's say, summer of 23. Just on a rate of change basis and due to the commodity prices that are coming back down, but they will not go down to the levels the Fed set at 2% or 3% or so. It will probably hit 4 to 5% range, something like that. And then if there is an event and a pivot that turns monetary policy around in the first half of next year, then we have excess liquidity again that will bring the second bull run in scarce commodities, and energy is part of that. And then we will have, let's say, $200 in oil in 24, and we have inflation rates at 10% and higher than they peaked in this cycle in 24, 25. And at that time, bond yields will be considerably higher. So that's how I see the inflation cycle to unfold. What will happen in the depression that I expect is a little bit far away, but I think the government will, it will not be a depression like in the 1930s, because we have not a rigid monetary system. We have fiat currencies. And what we will see is that the government becomes much more active to support the economies. You know, even today, 40% of all the bank loans in Germany are guaranteed by the government. In France, it is 70%. When you look at the government share of the economy, it is much higher. So I think we go into an administered, government-administered economic situation in the second half of this decade.
Okay, all right, that's great. I'm going to come back to you in a second, Felix, but there's a couple more questions I just want to quickly get to before we have to wrap up. Doomberg, there's a couple of questions on uranium and the nuclear industry. I know this is something that, again, you've done a lot of research on, you've written very well on. So perhaps I could throw these couple to you and you can answer them in whichever order you like. The first one is more a practical, real-world question, and that is the fact that as Russia is not particularly known for its high-quality standards of maintenance and repair, do nuclear warheads decay significantly over time? But perhaps more boots on the ground stuff is just uranium mining stocks. Does the lower inventories in the utilities in the US force them into buying more uranium, and what does that mean for the valuations of uranium mining stocks, particularly with the Sprott physical ETF now on the landscape?
Sure. So one of the things as an analyst is to make sure that you never respond to a question for which you don't have sufficient expertise. And the state of Russian nuclear warheads is not something that we have dug into with any significant effort. And so I would refrain from answering the first question, but the second one is a little more straightforward, which is there is a bullish tailwind towards the price of uranium, the commodity. Now, how the price of uranium, the commodity, manifests in the amount of money uranium miners can make, and then how that manifests in the valuation of uranium miner stocks is a completely different question. But there is, I mean, ultimately, physics will tell you that there is no path to any meaningful decarbonization that does not run squarely through nuclear power. And nuclear power does require uranium. And unlike, say, oil and gas, the cost of the fuel in this case is almost irrelevant to the cost of the electricity that a nuclear power plant produces, which means the price of uranium could double or triple from here, and consumers wouldn't notice it in their power bills. As I'm sure you're well aware, post-Fukushima, the price of uranium is such that most uranium mines in the world cannot turn a profit by operating, and so they are no longer operating. And the clearing price for the sort of equilibrium global demand for uranium is probably somewhere around $80 to $90 per pound, where uranium is trading today in the low $50 a pound range. The cost curve in the industry just dictates that most uranium mines cannot operate profitably at these prices. And so we are seeing a resurgence of nuclear power. And I think, and by the way, this the most disingenuous aspects of the environmental radical movement is this negative war against nuclear power, which has done more damage to more people on the planet with no impact on the environment than perhaps any other belief. This will be overturned. And we're seeing it already. Progressive governor of California with the life extension of Diablo Canyon, and the Pickering power plant in Canada getting a life extension, and even the Germans extending the life of their last 3 remaining nuclear power plants. The Japanese, desperate for every BTU of energy they can get their hands on, are restarting 9 nuclear reactors. The trend, the bullish trend behind uranium is there. The commodity we're very bullish on. How the market treats the underlying miners is a completely different question, for which we have not the best expertise to answer. But long term, if you ask me in 2028, is the price of uranium higher than $52 a pound that we see today? I would place my chips on the bet on the answer of yes.
Well, Felix, look, we've got 5 minutes left. And again, I'm going to wrap a few questions in here because there's a few more specific ones. Now, I know when you write to your clients, you keep them very much in touch with your feeling on various asset classes, and you point out times when you think action is required. But just in a general sense, a couple of questions specifically about the best investments that can be used to preserve buying power over the next 5 years or so, with a low probability of a big drawdown, and also your thoughts on the type of investments to buy post any Fed pivot, which is obviously the thing that everybody's watching out for.
Well, the next 5 years we'll probably see the biggest roller coaster in the markets everybody active in today's markets has ever seen in their lifetime, in my view. And therefore, I do try to trade the cyclical swings, and I do not like to make an investment and stick to it for 5 years, not knowing what the roller coaster exactly will be. So if somebody put the gun to my head and said you have to pick a chart, then I would pick gold and silver. Because they have been in a bear market or a bull market correction for many years. The bull cycle is going to start based on the 8-year cycle in 2024 and should run into the late 20s. And I think with the tremendous changes and rising uncertainty that we will see, and probably even war and broadening war in the world and big conflicts, I think a part of the money that is looking for a safe haven will go into gold. Now, I do not compare gold to the 1970s because that was an extra situation, because nobody could own gold before, and gold was frozen in price, and therefore it had a fantastic run. That may not be exactly the same thing. But I think gold should be an important asset to prevent you from the loss of purchasing power that we will all go through with the authorities that are in power and in central banks right now.
Felix, just to add to that, we touched on it a while ago, but cash. I want to just talk to you about cash because, again, you wrote in one of your recent updates that the best thing to hold in a cyclical bear market is cash in a safe place. And investors have become, I think, conditioned to thinking that holding cash is a bad idea and you should always be invested, you should always be trying to earn a return. Just talk a little bit about your mindset around cash at this particular point in time and how you look at it.
Cash is an asset like equities or bonds or commodities or whatever, and you have to play it and use it in the cycle in that your cash position is very high at the end of a bull market, and your cash position should be very low, the lowest it could be at the beginning of a new bull market. So cash is an important tool to use the opportunities that are available in the markets. If you do not raise any cash at the end of a bull market, you won't have any cash available to put at work at the bottom of the bear market. And that's why I think TINA has always been a bull market concept for a secular bull market. And the secular bull market, it may not be completely over. It may end in 24. I do not know, or it has already ended. But I think cash is an important tool for investors and portfolio managers to enhance your returns.
Okay, well, listen, we've literally got a couple of minutes left, so I'll give each of you a chance to offer some final thoughts to the audience, things you think people should take away and be thinking about. Doomberg, let's start with you. Any final thoughts?
Yeah, one thing I would say, we referenced this earlier, and I didn't get a chance to describe our view on it, but this relationship between the U.S. and Saudi Arabia, I think, is the most urgent thing to watch, and a particular milestone post the U.S. election next Tuesday is the progress of this so-called NOPEC bill, which is making its way through Congress. We wrote a piece called Listen, Jack, where we talked about how deeply personal the animosity was between U.S. President Joe Biden and MBS. And if you're looking for milestones to wonder whether we're going to see a seismic shift in the global geopolitical chess game, the progress of NOPEC in a lame duck Congress post-election before the new Congress is sworn in is a real milestone that our listeners should be looking towards and positioning themselves for accordingly, because already they're threatening to give Saudi Arabia the Russia treatment of confiscating their reserves, using the involvement or alleged involvement at 9/11 as a potential cover. And per Felix's opening point at the very beginning of this webinar, the U.S. is acting in a way that is making a lot of enemies around the world, and the relationship between Biden and MBS in particular is a true, we think, point source of potential chaos that everybody listening should keep a very close eye on. So that's one point that I wanted to make during this webinar that I didn't get a chance to, and appreciate the opportunity to do so before we close out.
Fantastic. Felix, a few final thoughts from you, if I may.
I would just like to add that the latest rumors I have picked up is that Saudi Arabia is developing missiles helped by Chinese technology. And if that is true, it's not confirmed, but if that is true, it tells you a lot where the world will go in future years. Well, I think the next important step is going to be determining where this recovery rally ends. I think it will be sometimes later in this quarter, and I believe that the first quarter or into spring will be a very big downdraft, and if we go in the S&P to the low 4,000, 4,100 or so, we could easily lose 1,000 points into the final low. And the final low, sometimes in the first few months of 23, will be a very important one, because I think the central banks will panic when that event comes, that is the pivot in the whole situation. They will panic, and the panic will lead to tremendous opportunities on the way up again for maybe 12 months or 18 months or so, not longer than that.
Perfect. Beautifully summed up. Well, listen, Felix, Doomberg, thanks so much for doing this. I've been thoroughly fortunate to be able to sit here and listen to the two of you talk. So thank you for that, and thanks to you all for watching. And thanks again to Doomberg and Felix.
Thank you, Grant, for moderating. You did a fine job as always. And thank you, Doomberg, for being on our webinar. I really appreciate it. We didn't know each other before, but I wasn't aware that we were on the same wavelength.
Indeed, it was a real great pleasure, and both of you guys are big heroes of ours, and it's really an honor to be here with you guys, and looking forward to meeting you in person, Felix, sometime soon.
So do I. Thank you very much.
Thanks, everybody. Bye-bye.